Good evening, everyone, and my name is Shaina, and I'm the co-founder and editor for FinMedium, and we are very, very happy to host our guest for tonight. Her name is Salonee Sanghvi, and I'm sure all of us are familiar with you in the FinTwit circle. Salonee is the founder of MyWealthGuide. She has over 17 years of experience in the financial services industry. She's amongst the first 40 women CFA charter holders in India and was recognized as India's top 100 women in finance by Association of International Wealth Management of India, as well as top 50 finance influencers on Twitter. She started a career with McKinsey India in their research department, gaining exposure to complex analytical frameworks and cutting edge tools. Thereafter, she did an 8 year stint at Rare Enterprises, which manages $2 billion proprietary portfolio of Mr. Rakesh Jhunjhunwala, India's largest private investor, where she was involved in several in depth value creation studies for several portfolio companies. The entrepreneur bugged Bit, and she co-founded Arctech, which worked to develop investment strategies for asset management using artificial intelligence. A very warm welcome, Salonee, and thank you so much for joining us tonight.
Thank you so much, Ghanisht and Shaina, for having me. Really happy to be here on this Sunday evening.
Thank you. So, Salonee, I've given a very bookish introduction of yours, but it'll be nice to know from you how your financial journey began before we bombard you with a lot of questions that we have got.
Sure. So, basically, actually, I'm a fourth generation finance professional. So, my great grandfather, was working in the industry. My grandfather was a stockbroker. My mother was a stockbroker, in fact, one of the few women stockbrokers in India. And so for me, I think money, talking about, investments, etc., was just dinner table conversation. And it was something I assumed that happened with everyone. It was just much later in life, in college and when I was working, that I realized that, oh, this is not something that's common knowledge. This is not something that people generally talk about, and that's actually essentially what led to me founding My Wealth Guide, basically a goal-based financial wealth management company to kind of help people understand investing and make better investing decisions. So it's been a great journey, since then. So that's just a little bit about how my wealth guide started and how I kind of got into it.
So, is My Wealth Guide your own firm, or you're the manager at that firm? How does it work? Or you're the fund manager? I mean, how does it work?
Sure. So my wealth guide is a company that I founded a few years ago. It's essentially a goal-based wealth management company that relies solely on data and research to help people make investing decisions, and we build customized roadmaps to help people essentially achieve their goals. But the larger part of that is also we manage equity portfolios. So we have a variety of equity portfolios that I manage. They're essentially quant-based portfolios to help people invest and pick stocks for their portfolio and invest in those.
Okay. So, Saloni, I mean, as you said, you manage portfolios and quant-based portfolios. And so you have basically come up with your own strategy to, shortlist these stocks. Am I right?
That's right. So basically, I've been in the in the financial services industry for 17 years with a very strong background in equity research. So I essentially took my experience of these 17 years, and kind of build it, took all the principles and philosophies of what I had learned over time, and essentially put it into building these portfolios, which is a set of defined principles and various parameters that we use to essentially pick stocks.
Okay, wonderful, wonderful. So I think we'll discuss that in detail a little later. So first, I think just to start with the investing bit, and considering that in the last 2 years, we've seen a lot of younger generation very keen to invest. But there is also a notion that, especially amongst youngsters and, people who want to start investing, that they can only invest when they have a large sum of money. I mean, is that okay, and is that correct? I mean, to a certain extent.
So it's interesting that you brought up this point. Basically, when we invest, it's essentially the magic of compounding that's working for you. Now, there are three parameters, that kind of work for that. One is how much you invest. One is what percentage returns you generate. And the third is the time that you hold that investment for. If you look at the formula, you see actually that the single most important factor to multiply wealth over time, over wealth is essentially time. That is also the factor that is completely under your control, unlike, maybe the investment amount or the percentage returns that you can get. If we look at one of the most known and successful investors globally, Warren Buffett, he started investing when he was 10 years old, and today at 90, he's worth 80 billion. If he had started investing at 30 and then, stopped, say, when someone would retire at 60, he would be worth only 12 million, which is not even 0.02% of his current net worth. So I think one of the first investing mistakes that a lot of people make is not let compounding work its magic. I often get this question, oh, this stock has already given me 50% return. Should I book profits? So I tell them once you invest, forget the money. Only if you give it time will it create substantial wealth. So, just to answer your question, it doesn't matter what amount you start with, even if it's 1,000 rupees. What is more important is how long you stay invested for rather than what amount you start. So, you don't need to wait or, to have like 10, 15, 20 lakh rupees to start. You can start with, an amount as low as maybe 500 or 1,000 rupees as well. The key thing is to start early.
Right, right, right. So yes, that is definitely starting early is the magic backbone of compounding. However, Saloni, if we talk about goal-based investing, and that's what we encourage a lot these days, rather than just investing for returns, etc. So, a youngster in 20s who's just started working, just started earning, for that person to plan about kids education, retirement, buying a house are very far-fetched goals, so they're not able to even relate to those goals. So how does one tackle that?
So, I just spoke about compounding and how time is key, right? Now, something like education. Education today is getting increasingly expensive. Say for example, if one child is going abroad today, it could easily cost anywhere from 1.5 to 2 crores. Which is not a small sum. A few years, maybe 10 years from now, that could easily be 3 crores, right? Secondly, retirement now is no longer at 60. There is no job security. No one gets a lifelong pension, unless they're working for the government. In fact, most people today want to retire by 40 to follow their passion, start a new business, etc. Right? So, another mistake that a lot of people make is thinking, oh, the goal is too far off, so I don't need to think about it. But what happens is accumulating such large sums in 1 year, 2 years, or even 5 years becomes very difficult. But if you kind of start towards those goals, 10, 20, 30 years in advance, it becomes much easier to kind of reach that target because the amount that you have to start with is much lower and it's far more manageable.
Yes, right, right, right. But is there a psychological, way to deal with the questions like this, that I just want to live right now, and I don't, why should I think about these things? I want to live it up. What is the need of investing? These are very common questions, that I'm sure a lot of especially the youngsters below 30 might have.
Right. So, I think that's a fair point. I think the idea is to maintain a balance between, kind of enjoying your money today and saving, for the future. Because see, we all know inflation and we all know the impact that inflation has, right? So, at the very basic, you want to maintain the lifestyle that you have today in the future. If you do not, if you do not plan or invest accordingly, you would not even be able to maintain your current lifestyle. Forget having a better lifestyle in the future. And today, honestly, life is far more uncertain because we don't have a social security net. There is no job security per se. So it is imperative to kind of think and plan about this a little bit in advance. The way that we look at it is, you should spend, but when you're spending, there's something known as conscious spending, where you kind of pick 2 or 3 areas in life that bring you joy and that really create happiness. Spend whatever you want on that, cut down on everything else, and then invest for your future with the rest of the amount. So when you kind of look at it that way, you're not compromising on your life today. You're doing things that you really enjoy doing, but you're also saving and ensuring that your future is secure.
Yes, I think that's very well put. Another notion, Saloni, we have, and it's passed on from our parents and the older generation, that FDs and insurance is equal to sufficient investment. Uh, that's a challenge we have, because we understand that it is not. But you know, how do we remove that confusion or that false notion?
So, I think this is something actually. I think if you open portfolios of most people would have, some form of endowment or insurance policy, etc. Because this, as you said, correctly, has been passed on through generations and probably one of the first investments that most people make. But it's very important to segregate the two. Insurance is essentially protection. So it could be life, it could be health, it could be, your property. But insurance should be solely for protection to manage risk from an unforeseen event that might happen in the future. If you were to look at, say, a 20-year policy which gave you 1 crore cover, and say you were still alive after that 20-year period, the insurance company would probably give you something like 3 crores at the end of it, which is great. But if you had basically bought a term policy which would give you a 1 crore cover and invested the rest, it would have given you 7 crores at the end, which is actually more than double. So it essentially using your phone to take photographs of your wedding. Would you rather have a nice, good DSLR taking photographs of your wedding, or would you just use a phone, right? So same way you segregate investment and you segregate protection. Another thing about say, FDs, a lot of people put their savings in banks or just FD. Now, there are two kinds of risks. One is obviously the one that you see, which is a capital loss in case if, say, the markets are down and, your portfolio is down. The other is the one that you don't see, which is opportunity cost. If the interest that you're earning on your money today is lower than inflation, then you're essentially not going to be affording the lifestyle that you have today. So the fourth mistake is not taking a risk that you can essentially afford to.
Yes, I think that's very well structured. So, coming a bit away from uh, these core personal finance topics to something more to your expertise, is that there are various forms and various strategies of investing these days that we hear so much about. There could be momentum, there could be value investing, there's growth investing. You spoke something about quant. So, I mean, there is all of this going on, and a person is constantly confused as to which to shuffle between. Am I a value investor? Am I a growth investor? And should one only have one strategy? So how does one simplify the process of investing? And should we stick to one strategy and learn more about it, or is it a combination? I mean, it can be very confusing for a retail investor.
Right. I think, and especially with the overload of noise today, you hear about so many different factors, strategies. It can definitely be confusing. I think there are many ways of making money in the market. There is no one single strategy or one single way only that would, help you create wealth. Rakesh Jhunjhunwala has a very different style from Radha Kishan Damani, right? So the idea is to find a investing style or manager that is in tune with your behavior and your personal investing style and stick to it. Money should ideally reduce your stress, not increase it. So, this takes a few trial and errors. It makes sense to try a few different styles to understand what style you're most comfortable with. Essentially, what style is something that is in tune with your behavior, because that's the only way you would stick to a single style for a long period of time, because at the end of the day, it's discipline that makes money rather than just one particular style. So it's very important to understand your temperament and then find an investing style that is conducive to that.
But Saloni, tell me, is it important to have a very complicated process to investing to earn higher returns?
I think at the end of the day, it is very important. See, complexities and complex products can be very exciting. But if you want excitement, go to the casino. Don't invest in what you don't understand. So I think it's very important to take the time to understand the risk and then invest, based on that. Like, for example, the other day on Twitter itself, I was reading about somebody who, bought options worth 50,000, and those options expired in the money, which means that he had to buy stock. I think it was worth some 35 lakhs. Now, he had invested thinking that his investment will be restricted to the 50,000 without really realizing what the risks were, and how the entire thing worked. So it is very, very important, to understand what you're investing in. And it's okay not to invest in something if you don't understand, because knowing the risks is actually the most important part of anything that you invest in.
Right, right. So, well, you know, as we talk about this, there is, and then you also rightly mentioned, there is a wealth of knowledge available on the internet, on Twitter, on YouTube. There are like thousands of channels, there are thousands of Telegram groups, etc. you know One person thinks that, I when I can get all of this learning for free, then why should I go to a financial advisor or a investment manager, and pay some fee? Why can't I just sort of easily uh, just just do that learning and then do a hit and trial investing?
Right. So, see, in life, we always pay. It could be money or it could be time, but there is always some form of payment that is essentially made. I think investing is like driving a car. You can drive yourself or you can have someone drive you. If you have the skill and the time to monitor stocks on a regular basis, then you should definitely look at doing it yourself. But if you lack either the skill or the time, then you should get help, get a professional to help you with it. A lot of people who invest in our small cases are actually from the financial industry. So they have knowledge, but they'd rather focus on their jobs and careers, which is what essentially is their forte and what they're good at, than focus on something, where they would have to spend a lot of time, and that is not their core focus area. So, if you don't have either the skill or the time or want the convenience, then you should definitely get help from someone. But if you feel that this is something you can do yourself, you have the skill, then you should definitely go ahead and do it yourself. But it's important to understand when you need help and then get it.
And Saloni, there's another very exciting option since, portfolios of these, big guys in investing in equity, direct equity investing are visible to the public. I mean, they have made it visible. So, well, why not just copy exactly what they own, obviously in the proportion which suits the lump sum amount you have, and then uh, just copy that thing to exactly, and make that your portfolio. So can one do that, and what would be the downfall of that?
So, I think first of all, it's hard to get access to the entire portfolio of any investor. What we essentially see is only the larger investments, that any of these successful investors have made. So, even if you know the names of the stocks, some of the stocks might be such a tiny part of the investor's portfolio that even if it became half, it would not make too much of a difference to their, portfolio. Because, see, their risk appetite at the end of the day is not yours. Their conviction is not yours. Their holding period is not yours. And their asset allocation is also not yours. Also, in case if they exit the stock, you will get to know much later. So, by then the price would have already moved substantially. So instead of trying to directly copy portfolios of, the great and successful investors, it makes more sense to learn the thought process behind it because it's very difficult to invest on borrowed conviction.
That's true. That's true. And and exactly, it is difficult, and you can't match the timing, that which is very critical for those guys, and when they bought it, how much they bought it for, and when are they exiting. So exactly, a very tricky thing to do and very risky thing to do. So, Saloni, you come across so many retail investors. You have a wealth of experience. What is something that you think is a very common mistake, or mistakes that investors, especially long-term investors, make these days, which you would strictly want to advise them against?
So I think a lot of investors have entered the market, in the last 2 to 3 years. So they've not really seen a true bear market. I started working with Rakesh Jhunjhunwala in 2007. So this was, the peak of the bull market, and everything for that 1 year, everything was going up. It didn't matter what you bought, everything was doing well, everything was going up. And then Black Monday happened, which was one of the biggest crashes, not only in India, but globally. And, stocks were down 20-30% in a single day. Everybody was in a shock at that point. It was very difficult for the mind to react. And over the course of the years, the markets corrected 64%. Now, amidst all of that gloom, very few people could actually muster the courage to buy when it was a once in a lifetime buying opportunity, right? This made me realize how even the most experienced investors, can become numb in a crash, and how much emotions actually affect our investing. So I think one of the biggest factors that investors need to understand today is how their biases and emotions actually play such a large part, and have such a huge impact on investing. I think that is something that most people, even people who've been around for a long time, are not aware of, the impact that that has. So I think that is something that's very important for all investors, new or old, to understand and to be aware of. Shaina, are you there? Ghanisht?
Shaina's having some
Sorry.
difficulties.
Yeah, I got dropped off.
Welcome back.
Yeah, I just sort of got dropped off. So, thank you, Saloni. I did hear the answer, and thank you so much for sharing that. And yes, you're right. We have a lot of newbie investors who have really not seen what a true hard hitting correction is. So, Saloni, what is your overall general philosophy towards making a portfolio, not yours, but making a portfolio?
I think for me, there are essentially four core principles that I follow. The first is to essentially eliminate emotions and subjectivity entirely from the investing process. Let's look at how much that actually impacts your return. So, Access did a study from 2003 where they found that even if their fund returned a 19% CAGR over that period, investors earned only 13%. That is 6% lower. So, investors are getting 10x returns instead of 27x that the fund earned. And this was only because emotions were affecting their investing, or because people would try to time the market or move in and out based on what was happening. The second core principle that I try to follow is to react quickly to protect the downside. Peter Lynch actually very famously said that selling your winners and holding your losers is like cutting the flowers and watering the weeds. Just to give an example, we recently had the Paytm IPO, and shares were allotted at 2,150. It listed in 1950, and a lot of people knew that they should sell maybe because the business model was not sustainable and other reasons, but got too greedy, thinking, okay, let me wait at least till the price reaches my cost before selling. Today, the price of that stock is, I think, around 800, 850 rupees. So, taking the decision to sell when you're losing money is one of the toughest, but also one of the most important. I think we spend 90% of our time focusing on what to buy and when to buy, without focusing at all on when to sell. So, for me, personally, I think there's a very strong focus on knowing when to sell, and that help. It's very crucial to quickly protect your downside because stocks can fall 50%, and while you're waiting for it, to come back up, it can fall another 50%, leaving you with a 75% loss. So it is essential to protect your downside. The third principle, I think, is to ride the winners. Now, I bought Marico, in 2008 when the markets had crashed. I think it was maybe 25 rupees that time. And it became about 5x in 5 years. So I sold Marico thinking, okay, 5x is a great return, or let me sell it because it's a good return. But it went up by another 5x from there. So it's important to let your winners win, let your winners run, rather than just booking profits and exiting it too early. And the last, and I think again a very important principle is don't try to time the market. Again, Peter Lynch said far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. I've had people telling me since October 2020 that markets are too expensive and, we should exit, etc. Now, some people didn't, and they're extremely thankful today that they didn't. And those who did regret because we've seen what has happened to the markets in the last 1.5 years. In fact, we've the markets have been falling recently in the last few months, and everybody's getting very jittery. But intra-year correction of 10 to 20% is essentially as common as your birthday. It happens in every single year. I've worked with a lot of smart people, and I've never seen anyone being able to predict the time and the magnitude of crashes. So instead of preemptively trying to time the market and losing out, I think it's more important to have a robust risk management system that reacts very quickly to protect your downside. Like just for example, in March 2020, when the markets fell by 38%, the portfolio was down only by about 22%, so it substantially reduced how much the portfolio fell. So I think these are essentially the four core principles that I follow in my own portfolio and in the portfolio that I manage as well. I think that these essentially are very important, and some of these are also not actually given due importance.
I think you're right because a lot of investors move on hope, and they keep waiting that, oh, this is going to pick up, this is going to pick up. Some that buy the dip is becoming very popular, but people start buying the dip without analyzing the fundamentals, and they are just themselves only dipping with the stock, and it just never picks up, and the losses mount, as you rightly said. So it is important to cut off the weeds. It sometimes seems very hard to bear that loss of even 10 to 20%, but I think it's a much better deal than bearing a 75% loss and a capital and complete capital erosion altogether. So, Saloni, you haven't mentioned anything about, in your principles. You didn't mention about, judging a stock by, or a fund maybe by past returns. So, is that an important criteria for you, or is it not to be focused on too much?
So I think that when you look at past returns, or when you backtest strategies, etc., it gives you a sense of how. See, it's very easy to make money in a bull market, right? Because most things are up, most things will do well. The idea is to understand how it would perform during a bear market or during a sideways market where not much is happening. So you want something that will actually do well for you over various periods of time. So I think that when you look at past returns, or you look at backtested performance, etc., it gives you a sense of how it helps you evaluate how this has performed over various economic and market cycles, and it's important to analyze that, because while, say, a fund manager, or while someone might say something, at the end of the day, what what they've done is far more important than what someone would say. So I think that every time, see, the crisis that will come is different. The the exact event that happens will be different. That will not maybe repeat. But the philosophy, the underlying philosophy remains the same, right? So it helps you understand how that performs across various cycles. So I think that it definitely does help understand better when you kind of look at. Obviously, past returns are no guarantee of future return, but it just helps you understand better how it would work during various market cycles.
Right, absolutely. So, well, Saloni, we've had some interaction. So, is it okay if I open the floor now for a few questions from the listeners? We had a few requests, and I request everybody who has a question, you can send us a request. We'll make you a speaker, and I guess we'll take it from there. So, please send in your requests, and Saloni will be happy to address your questions. And in the meantime, Ghanisht, do you want to add something or ask something?
No, Shaina, this was I really like the point where Saloni said that majority of her clients are actually finance professionals, because as a merchant banker, I can also reflect on this, that I am so busy with my business that I really don't get enough time to invest and do it on a full time basis. So that was a brilliant point.
Yeah, that's something actually we've seen, live, and I think that's the reason we also developed the small cases and the strategies that we did. because these are strategies that are usually only available, via the PMS route with an investment of 50 lakhs and above. So our aim was to democratize, these institutional level strategies to enable everyone to be able to gain exposure, at a much, much lower investment amount.
Before we open the floor to questions, Saloni, can you tell us more about your small cases?
Sure. So we essentially have three main small cases that invest directly into stock. The small cases are based entirely on a quantitative investing style. So we use purely data to kind of analyze companies and invest in them. The advantage that this gives us is it completely rules out emotion and bias from the entire investing, the entire investing process. So my biases regarding, say, certain stocks that I like or I don't like don't enter into the picture at all, because we just use the system that we've developed. The other benefit is also that, when you have someone analyzing stocks, even the largest brokers maybe can do 200 stocks or so. They can, analyze that many. But because we use technology, we're able to analyze more than 700 stocks in greater depth and breadth. So it helps us catch a lot of, hidden gems that are missed out by other people that we can invest in. So we structured the small cases. There are three main segments. One is MWG ESG, which follows a ESG plus quant strategy, and it invests essentially only in large cap stocks, so the top 100 stocks in India. Then we have MWG Smart Alpha, which is essentially like a multi-cap or flexi-cap. So that invests across, that is market cap and sector agnostic. So it can invest, in large cap, mid cap, small cap, wherever the opportunity is based on the stock. And the third one is MWG Small Cap Star, which essentially invests in small caps and small caps that have now become, mid caps over time. These are our three main stock-based small cases. We also have an asset allocator small case which invests in ETF, so that essentially reduces the volatility while still giving you, your market return. So that invests essentially in the top companies in India, in US, and in gold. So these are the main strategies that we follow for our small cases.
So, Saloni, which small case is your personal favorite?
Which is my personal. So, I personally have invested. I am a strong believer in skin in the game, because if you've developed something and if you genuinely believe in it, then that's where your investment should be. So my personal investments, are in MWG Smart Alpha, which is the multi-cap or flexi cap small case, and MWG uh, small cap stocks, because I think small cap stocks is where you have a lot of opportunity and potential for a long period of time. So a substantial amount of my own portfolio is invested in this.
Thanks, Saloni. That's all from my side.
Peloni, do you see a certain sector or a certain sector? I will not ask anything narrower than that. That is that you feel is going to be the sector for the next year or the next couple of years.
So, as such, we're sector agnostic. So we would invest in stocks across sectors, or, even in the same sector. That being said, I see a lot of potential, in the chemicals and technology sectors going forward. I think technology, obviously, we all know, how technology is moving and what is happening in that space. So I see a lot of potential in these two sectors going forward.
So, Saloni, I think one question from my side is that there's a lot to learn in direct stock investing for a retail investor. So is small case in that case becomes a much better offering, right? Or is that learning or monitoring of the portfolio still as much in a small case?
So, I think the advantage with small case is that you have a professional manager, whose full-time job it is essentially to monitor and study the company. So you get benefit of, like say for example, now I've been in the industry for 17 years, so you can directly get the benefit of that without having spent 17 years in the industry. Also, if see, we can no longer, you can no longer buy and forget. When you invest as well, you need to be tracking, the stocks over time, or you need to ensure that in case if there's any substantial change in the business or if there's any substantial change with the company, you need to be on top of it. You need to track it. So you need to monitor a minimum on a quarterly basis, if not more frequently. So I think small cases makes that very easy because you have someone professionally managing it, someone who is looking after your stock. And obviously, because of technology, it becomes very easy. So it's essentially one click investing in a way, which makes it extremely easy for anyone. All you need is a broker account, and then you're ready to go.
That sounds simple enough. In fact, it's been very exciting for me also to uh, learn so much about small case from you and your team, and now I'm really interested to explore it personally. So, I think last few minutes. So, if there is anybody, I think we had a few requests, but now they're back to the listener status. So, if there is any person, they can raise their hand uh, for any questions from Saloni. Otherwise, we'll have to end the session here. So I'll give it a minute or so because there were a few requests and now I can't see them. So yeah. Saloni, are there any more news? New set of small cases coming up for you?
So actually, MWG Small Cap Stars, is our latest small case that we just very recently. Because I think small cap is a very exciting space. That's where you would have the maximum potential, So that's something that we very recently launched.
Okay, wonderful. So we have Nandan. I've added as a speaker. So Nandan, can you please ask your question and unmute yourself and ask your
Yeah.
question?
Hi everyone. Hi Saloni. Just wanted to know right now. You just said that small cases are better in terms of they're being managed by some analyst, and it's for the retail investors. It's better to work through small cases. But on the contrary, you being yourself an analyst or a financial advisor, what do you suggest one should go for? Small cases or financial advisors?
I think that depends on what and where you want to invest in, essentially, because I think a lot of the large advisors are on small cases for equity. So if you're looking at direct equity, I think small case is definitely a good and easy way to do it. Obviously, if you're looking at other investment options, those are not available on small case. So then, in that case, you would, look at a financial advisor direct.
We have another speaker, which is vegan investor. So please unmute yourself and ask your question.
Yeah, hi, thank you. Maybe you have already answered it, but I joined a little late, so I'm just asking it again. So if I compare small case with SIPs in mutual funds, which one you recommend? Again, I'm not thinking from the perspective of either or, but what if I choose both? Because I have never invested in small case till now.
Sorry, your question was SIPs and mutual funds, right?
Yeah, SIPs in mutual funds versus small cases.
Okay. So again, I think that depends on what you're looking for. I Mutual funds are definitely a great option, especially for retail. But what I feel is that because they're geared for retail, sometimes the risk profile of the funds is far more conservative. In a small case, especially if you're a younger investor, you can take a higher amount of risk. Again, this depends on your risk profile, but you can take a higher amount of risk. Plus, because of the size, small cases are able to invest in a lot of stocks that mutual funds can't because of their size. So there are a lot of opportunities in those spaces that you would have access to, and that you can take advantage of. So
Okay, just one. Yeah, sorry. Go ahead. Yeah, okay. So I had one more question. So a lot of these small cases are being created by, like all of these YouTubers and all, and they said, oh, buy my small case, it has given this much investment. So, and they are not even like, like registered advisors or anything. They are just creating small cases for their followers. And I don't know if people are buying it, but I just find it very risky. I mean, so yeah.
So I think choosing an advisor is just as important as choosing a life partner, because that person, you are going to have a long-term relationship with that person. So it's very important that you do your due diligence and your research, on whoever you're picking to be your advisor or small case manager, be it with me. I think you should spend a lot of time on that because obviously you're not going to invest for 1 month and then kind of exit. So I think it's very important to kind of look at their credentials, look at, listen to them speak, what is the knowledge that they have, and then decide, who you want to kind of pick. Another thing actually that I personally feel is also ideally pick someone who's seen at least the 2008 crash, because only once you've kind of lived through a real bear market do you know how to deal with it, and do you know how that impacts a lot of your investment.
Thank you.
So I think we are at the fag end of the session. So, any closing remarks, Saloni? Any advice to the investors currently with the current situation and how things are currently? It's very volatile. It's totally up and down. So, what is your final closing comment for the listeners today?
I think, there's a lot of noise that happens around, and it's very important to be able to distinguish what is and what is actually relevant. So there will always be events that will happen every year. There will be events, like for example, right now you have the Russia-Ukraine crisis, Fed rate hikes, etc. But it's important to kind of zoom out and focus on, the longer term. So we're seeing a lot of structural changes that are happening in India, in terms of government policies that are coming to bear, in terms of investment that is happening, in terms of also, we have a huge amount of people moving to the middle class and higher. So huge amount of spending and consumption that is going to happen going forward. So it is important to kind of zoom out and keep an eye on these factors, which I think will actually propel India to a growth that we haven't seen, historically. So I think that is something that is important for everyone to note. And again, as I said, it's very important to ensure that you're able to cut emotions and biases from your investment. Ideally, focus on data. Use data. Data is your friend, and use that for investing. If you feel that you are unable to do it yourself and you need help, you can always explore our small cases on mwg.smallcase.com. we have different small cases, for different people, different requirements. So whatever suits your requirement. And yes, I think that's it from me. In case if you have any other questions, you can always just reach out to me and, shoot your questions.
So I guess if there are any questions and if there are any queries about Salonee's small case, she is available on Twitter and on mwg.smallcase.com. You can also reach out to FinMedium and we can translate or pass on your queries to her. We'll be happy to do that. So thank you so much, Salonee. This was a very enlightening session for everyone. And thank you for sparing out your time on a Sunday evening for all of us. And I'm sure we are taking back a lot of knowledge and we are ready to face Monday with a fresh perspective and definitely have more stable returns in the future. So thank you so much for being a part of this session today.
Thanks,
Thank
Saloni.
Thank you so much, Shaina and Ghanisht, and thank you everyone for tuning in on a Sunday evening. For joining in. Thank you so much.
Okay, Shaina, let's close. Good
Thank
night.
you. Thank you, Salonee. Thank you, everyone. Have a good night. Yeah, let's close, Ghanisht.